None of us really know, right? We're all kind of speculating, but I think that something could break, and in which case they have to respond. I mean, you notice Warsh said he believes in shrinking the balance sheet, but he also, in the congressional testimony, he also said, in case of a liquidity emergency, we stand ready to provide whatever liquidity is necessary, which means we would grow the balance sheet massively, right? So if quote unquote, if something breaks, there's going to be a third big print, and the Fed balance sheet is going to go from 6.7 trillion to 20 trillion.
Imagine waking up to headlines announcing that the Federal Reserve has expanded its balance sheet by trillions of dollars almost overnight. It sounds like the kind of event reserved for a once-in-a-generation financial crisis. But according to Larry Lepard, it isn't a remote possibility, it's the logical destination of a debt-based monetary system that is running out of room. His argument isn't built on speculation or market hype. He says it's built on simple mathematics. Lepard believes the biggest mistake investors are making today isn't underestimating artificial intelligence or overestimating the stock market. It's failing to recognize the pressure building beneath the global financial system. As government debt continues to grow at an accelerating pace, he argues policymakers will eventually be forced into another massive wave of liquidity creation. And if that happens, the consequences could reshape the prices of every major asset class. That is why Lepard is making one of the boldest forecasts in today's macro landscape. He believes gold could climb to $7,000, silver could reach $200, and Bitcoin could surge to $200,000 within the next 18 months. Those numbers may sound extraordinary today, but in this interview he explains why he believes they are simply the mathematical outcome of an unsustainable debt trajectory, relentless monetary expansion, and a financial system that cannot afford prolonged tight policy. In today's video, we'll break down why Larry Lepard believes another big print is becoming increasingly unavoidable, why he says the market has completely misread the Federal Reserve's next move, how global debt and money supply are driving his extraordinary price targets, and why Bitcoin could be one of the biggest beneficiaries once liquidity returns. If you enjoy deep macro analysis without the hype, be sure to like this video, subscribe to the channel, turn on post notifications so you never miss an update, and let us know in the comments, do you believe the Fed can avoid another round of large-scale money printing, or is it only a matter of time?
Why I'm so bullish is it's really just math, and I would say just to condition those projections, I think you got to give me 18 months. I don't, that's not happening tomorrow. And by the way, it could happen in quicker than 18 months, but I'm very confident in 18 months that we'll be at all three of those numbers. And let me explain why. The math of the situation is such that the global money supply needs to grow aggressively in order to support the growth of debt. And this has always been the mismatch and the problem with a fiat currency system. And, what happens is that as the debt continues to grow and they try and grow debt in order to fuel growth, the money supply has to keep up with it because there has to be money to pay the interest on the debt and to make principal repayments. And as we all know, the debt has been growing very rapidly and almost at an increasingly rapid rate. And yes, as you're posting the U.S. debt clock, I mean, we're very close to going over the $40 trillion mark. And it didn't take very long for the last $3.5 trillion to come in. It's come in the last year and a half. And so, what's gone on is that the Fed has been restrictive since early 22 when Powell, generally restrictive when Powell increased rates to fight the COVID inflation. And then they started a small cutting campaign, but they've stayed more on the restrictive side last year. And I'm making the bet that they just can't continue to do that they are either going to have to cut rates or that there's going to be another market accident as a result of the money supply not keeping up with the debt growth. And this is really what happened in 2008, and it's what happened in COVID. And, there's some charts that I've shown in the past in my presentations, my quarterly reports, that show this growth in money supply tracking the growth in debt. And so, what I would say is that that's going to lead to what I call the next big print. And we've already had two big prints, one in 2008, one in 2020. And I think they're going to be forced into doing another one. And there are already starting to be cracks in the system that suggest that it's very likely to come within the next 18 months. The market has really got this wrong. I mean, they've been head faked and they're believing that the Fed is going to be aggressive, and they're believing Kevin Warsh's rhetoric. He had the first press conference and he said price stability like 12 times. It was like he was protesting too much. I mean, they can't raise rates. I mean, the whole odds on raising rates of 70-80% in the next 6 months, that's just nonsense. And in fact, they want to cut rates, and they've as much as said that. I mean, pre the Iran war issues of the inflation burst from that, he said he thought AI productivity would allow them the space to cut rates. And they've really come at this much more from a kind of a, people are calling it a Hamiltonian, for our first Treasury Secretary point of view, which is to say they're supply siders. And they believe that lower rates make capital investment easier. Additional capital investment leads to more supply, and that more supply will bring down inflation. So they actually are not of the belief that raising rates necessarily addresses inflation. They prefer to come at it from a supply side solution. Now, that's in my view not a bad idea, but it's certainly, if they lower rates, it's going to be inflationary because it's going to lead to additional growth. And in fact, that's really what they've said, is that they want to run the economy hot. All three of them. I mean, and I consider Bessent and Warsh and Trump to all kind of be on the same page here, and that is that they're going to run the economy hot, they're going to run inflation hot, they're going to lie about it, and that they're going to try and grow their way out of this debt burden. Now, if they somehow decide to actually get religion and raise rates, something's going to break, and we've already seen the beginning of that. I mean, the Japanese currency has started, quote unquote, breaking, as has the Japanese bond market. And we just saw Bessent had to come in and provide a swap line to them. We don't know how big it is yet, but that's kind of interesting.
Larry's central argument is surprisingly straightforward. Every dollar of debt requires liquidity to service it, and as governments continue borrowing at record levels, the financial system eventually reaches a point where restrictive monetary policy becomes impossible to maintain. In his view, policymakers will ultimately face a choice between protecting the currency or protecting the system itself, and history suggests they always choose the latter. That brings us to the next question. What actually forces central banks to reverse course? Larry lays out the chain reaction he believes could unfold, from stress in bond markets and rising deficits to yield curve control, renewed balance sheet expansion, and why that sequence could become the catalyst that finally sends Bitcoin, gold, and silver into the next major phase of the bull market.
We all know is that these fiat currencies, both the yen and the dollar, are just tragically flawed compared to currencies which can't be printed. And there's the old-fashioned currency that can't be printed. It's not really much of a currency anymore. It's more of a store of value, but that's gold, and that's analog sound money. And then there's the modern version of sound money, and the better modern version of sound money, which is Bitcoin. And, that can't be printed either. And so people are going to start to favor these assets that protect them from the money printer that the government continually uses.
So what's the road between here and the prices actually going up? So right now...
Well, yeah, that's a great question, and none of us really know, right? We're all kind of speculating, but I think that something could break, and in which case they have to respond. I mean, you notice Warsh said he believes in shrinking the balance sheet, but he also, in the congressional testimony, he also said, in case of a liquidity emergency, we stand ready to provide whatever liquidity is necessary, which means we would grow the balance sheet massively, right? So if quote unquote, if something breaks, there's going to be a third big print, and the Fed balance sheet is going to go from 6.7 trillion to 20 trillion, because what they'll do. I mean, so let's describe how something could break. Something could break in terms of the stock market going down, or further problems in Japan, or just the U.S. bond market saying, we're not going to sit here and tolerate these high rates of inflation and receive a 3.7 yield or something, or 4.7 yield on a 10-year treasury. It's just not worth it to us. And so we're going to sell that off. And if yields go higher, then the deficit gets larger. If the deficit gets larger, they've got to finance it with more bonds being sold in the same size bond market. And so rates go higher still, and it's a doom loop, right? And so eventually what will happen is that Bessent and Treasury and the Fed will all be forced into, yield curve control. And wherein they say, they did this in World War II, by the way, they set yields at 3/8 of a point in the short end and 2.5 in the long. They started at 42. And they'll basically say, hey, look, we're going to set these yields at this rate. You can only earn 5.5 on a 10-year or 4.5 on a 10-year U.S. government. We intend to defend that. And the bond market will look at that and say, oh, I mean, I can only get 4.5 and inflation's printing at 7. That's a shitty deal. I don't want these anymore. Here, Fed, you can have them. And so they'll sell them to the Fed. And what will the Fed buy them with? Newly printed reserves, right? And the newly printed reserves will take the Fed balance sheet from 6 to 20 trillion. And as this goes on, Rand, what's going to happen is everyone's going to realize they can never stop printing. And that's the bottom line. I mean, the bottom line that people, it's amazing how slow people are to catch on to this, but they can just never stop printing. They're going to have to print forever.
I mean, I want to address the elephant in the room. Like, why does Bitcoin not respond to all of this?
Bitcoin responds, but with a lag. Okay, Bitcoin is a liquidity indicator. Bitcoin is actually telling you that they need to print more money because it's so tight and the price is so low. Okay, and it will respond to the monetary stimulus, but with a lag. And what we need to see right now, the market and the world thinks that Warsh is just like they thought Doge was going to work, which it didn't. The market and the world think that that Warsh is a hawk, and he's going to raise rates and they're going to tame inflation. And I couldn't be more in a opposition to that point of view. He's not a hawk. They're not going to raise rates, and they're not going to tame inflation. And so once all three of those things, once the market becomes aware of all three of those things, that will ignite the gold, silver, and Bitcoin trade. Now, one thing to keep in mind, though, is look for the clues in gold and silver first, because we've got this 16-year overlap of gold and silver compared to Bitcoin. And what you see is that gold and silver are more broadly distributed, and they smell it first and move first.
Whether you agree with Larry Lepard's conclusions or not, his thesis challenges one of the market's biggest assumptions that central banks still have the freedom to keep monetary policy tight indefinitely. His view is that debt has reached a level where maintaining restrictive conditions eventually becomes more dangerous than accepting higher inflation. If that assessment proves correct, then the next major move in financial markets may be driven less by economic strength and more by policy necessity. His outlook also offers a different way of thinking about Bitcoin. Rather than viewing it as simply another risk asset, Lepard argues that Bitcoin behaves as a monetary asset that responds to expanding liquidity. That helps explain why it can appear frustratingly quiet while financial conditions remain tight, only to accelerate once monetary policy shifts decisively toward easing. In his framework, Bitcoin isn't ignoring macro conditions, it is waiting for them to change. The same logic extends to gold and silver. Lepard believes these assets have spent decades serving as protection against the long-term erosion of purchasing power, and he expects they will once again lead the market if confidence in fiat currencies continues to weaken. His message is clear. The real story isn't today's inflation reading or the next interest rate decision. It's whether governments can continue financing ever-growing debt without resorting to larger and larger rounds of money creation. Ultimately, the question isn't whether another financial shock will arrive, but how policymakers choose to respond when it does. If Larry Lepard is right, that response could redefine the investment landscape for years to come. If you enjoyed this analysis, don't forget to like the video, subscribe to the channel, share it with anyone interested in Bitcoin and macro investing, and leave your thoughts in the comments below. Thanks so much for watching, and we'll see you in the next video.